Today, we're looking at a detailed analysis report on Plug Power.
Right, and it's asking that big question. Is PLUG stock a buy right now? Specifically at that $2.23 entry point.
Exactly. It's trying to weigh some of these recent operational wins against the, frankly, massive risk of future share dilution. So let's just get right into it. The first thing that jumps out is that the analysis presents a pretty fragmented strategic direction.
Oh, definitely.
It's trying to serve, aggressive short-term traders and conservative long-term investors all at the same time.
I saw that tension right away. I mean, the verdict section calls the 223 position a high-risk, high-reward speculative buy.
Right.
That's clearly for traders who are in and out quickly. But then in the next breath, it gives a hold-wait recommendation for long-term investors.
And that's the whole issue right there. The core of the report, all the supporting data, is clearly about that tight technical breakout play.
The one targeting 260.
Yeah, with that unforgiving 208 stop loss. That whole setup just screams short-term execution. So by trying to speak to both the trader and the long-term holder, the report, it just ends up with conflicting advice. It hedges its strongest point.
It really does. It makes you hesitate. You see this compelling, aggressive setup, but then you're immediately told, well, if you're a long-term investor, you should wait. The analysis needs to make a choice. Which audience is this really for? And given the, let's be honest, the huge risks with this stock, trying to satisfy two opposite strategies just weakens the entire thing. The momentum play is clearly the dominant idea here.
So that decision has to be made explicit. The suggestion for improvement is to just streamline the report, focus it exclusively on that one dominant viewpoint.
The high-velocity short-term trade.
Exactly. The one driven by the NASA catalyst and that tight 225 resistance. The situation with Plug is just too complex for a split focus.
Absolutely. And the long-term view, that's based on a completely different set of ideas, right? It's all about whether Project Quantum Leap can actually get them to positive cash flow someday.
Which aligns with the current analyst consensus, the majority hold.
Right. So that's a totally separate, slower-moving analysis. It really deserves its own section, away from the main trade idea.
Okay, so let's talk about how to actually do that. To get that laser focus, first, you've got to reframe the executive summary verdict. It needs to state it plainly. This is a speculative buy at 223, and it's entirely based on breaking 225 before the market starts fully pricing in that January dilution vote.
And you have to get rid of that visual conflict in the main strategy table. That whole row for the conservative investor.
The one that says, wait for a close over 230?
Yeah, that one. It has to go. Move it out of the main strategic entry plan table. Put it somewhere else, like in a long-term outlook section.
That separation is critical. So the main table, the strategic entry plan, it should only have the tight, high-risk parameters.
The aggressive buy, the 255 to 260 target, and that hard 208 stop loss.
By doing that, the analysis just gains so much conviction. It removes all the ambiguity about the speed and the risk you have to take on.
With a stock like Plug, which is in the middle of this huge turnaround attempt, with existential questions about its cash flow, clarity is everything. Hedging just undermines the confidence you need to actually pull the trigger on a trade like this.
All right, let's move to the second major area. While the report does identify the potential doubling of the share count as a huge risk,
a massive risk,
it doesn't really integrate that threat as a present strategic anchor, something that's weighing down the stock right now.
This might be the biggest weakness in the whole piece. The dilution risk, going from 1.5 billion to 3 billion shares, it's just listed deep in the bear case section.
It's sort of treated as this future problem.
Exactly. Something tied to a meeting in January 2026.
And separating it from the technical analysis is just a huge missed opportunity. It doesn't explain why that immediate resistance band at 225 to 230 is so incredibly stiff.
Or, and this is the important part, why the trade has to be done with such urgency and with such a tight stop at 208.
That's the real story the report needs to tell. Institutional traders, the big money, they aren't waiting for the vote to factor in that new supply.
No way. They're already pricing in the fact that management is almost certainly going to have to sell shares to cover that, $670 million hole in their free cash flow?
Exactly. If you're burning that much cash and the stock is at $2, you have to issue hundreds of millions of shares just to keep the lights on. That anticipated supply, it just creates this invisible ceiling on the price.
So the suggestion here is to aggressively weave that dilution cloud directly into the technical analysis. You have to reframe that 225 to 230 band as the explicit price ceiling.
Let's call it the dilution cap.
The dilution cap, I like that. The report needs to argue that a successful trade means getting in and out before the weight of that January meeting fully crushes the stock.
This is what takes an analysis from just, reading a chart to explaining the economic forces that are actually moving the chart.
So how do you do it?
Let's get concrete. In the technical analysis section, you connect the 225 immediate resistance directly to the dilution. You argue that this ceiling is precisely where institutions who know the company needs cash are selling into any strength. They're capping the price.
And you do the opposite for the stop loss. You strengthen the argument for the 208 stop loss zone using that same context.
How so?
You argue that a drop below 208 isn't just some technical failure. It's a clear signal from the market that it thinks the dilution risk is insurmountable right now.
So it immediately invalidates the whole bull case.
It completely invalidates it and makes 208 an unforgiving line in the sand. If the price breaks that level, the dilution story is won.
By making the dilution the reason for the resistance and the justification for the urgency, the whole aggressive nature of the trade suddenly makes perfect sense. It becomes a calculated sprint to grab a profit before the gravity of all that future supply kicks in. Okay, let's turn to the fundamentals. The report highlights some big successes. The NASA contract, Project Quantum Leap, but they're presented more like separate bullet points.
Right, they're not positioned as the core mechanism that's actually driving the entry at 223.
And that's about making the case persuasive. The bull case correctly notes the NASA contract, even though it's small, only $2.8 million, and the progress on cost cutting.
Yeah, that 97% uptime at the Georgia plant is impressive. It's a great counter-argument to the bears.
But then the technical analysis section starts talking about levels, 223, 230, without really using those fundamentals as the reason for the breakout anticipation.
It just relies on this vague idea of momentum.
Exactly. The technicals and the fundamentals feel siloed. The operational news feels like it's just nice to know, not need to know for the trade.
And for a turnaround story like Plug, a technical bounce has to be backed by proof that the company is fixing its cash bleed. Otherwise, it's just noise.
So we need to make a more explicit, more mechanical connection between those operational wins and the confirmation of the bullish divergence on the chart.
The fundamentals have to become the tactical justification for making the trade.
Okay, so let's focus on how to fuse them together. When the analysis describes the bounce off that 192 support level, it should state clearly that the bullish divergence is validated by the progress of Project Quantum Leap. That 97% uptime isn't just a stat, it's hard evidence that they are fixing the operational problems.
So it makes the technical bounce feel more sustainable.
Yes, at least for the short term. It's not just random market volatility.
And what about the NASA contract? It's so small.
Its value isn't the dollar amount. The analysis needs to frame it not as a confidence booster, but as validation of Plug's liquid hydrogen supply chain.
Which is critical for winning bigger contracts down the road.
It's the specific market event that provides the fuel to even try to challenge that 225 dilution cap.
Ah, okay.
That justification changes everything. It takes the analysis from just, hey, the chart looks good, to the opportunity at 223 is justified by real operational progress, and we have to act before the dilution risk takes over.
It's the reasoning that supports the aggressive trader approach over just waiting.
Exactly. By linking fundamentals directly to tactics, the report builds a powerful, integrated argument. It really leverages the deep research to create something highly actionable for that specific audience. So, look, this analysis report has all the right pieces for a high-conviction thesis. It just needs some structural work to really maximize its impact. Let's quickly recap the 3 core areas for improvement.
Okay.
First, sharpen the strategic intent. Focus the primary analysis only on the high-risk, short-term momentum trade.
And separate it from the long-term outlook. Move that conservative plan out of the main strategy table.
Second, you have to integrate the massive dilution risk directly into the technical analysis.
Right. Framing it as the current price anchor, it's what justifies the stiff 225 resistance, the dilution cap, and the urgency of the whole trade, and that tight 208 stop loss.
And third, make sure the strong fundamental news, the NASA contract, Project Quantum Leap, are used as the explicit, mechanical justifications for the tactical entry at 223.
Use those operational wins to validate the technical bounce and reinforce why this is a smart, calculated bet against the consensus price target.
Focusing the argument, integrating the risk, and linking the fundamentals will create a final report that's not just robust, but also highly persuasive and, most importantly, actionable for that high-velocity trade.